Hello and welcome back to another session within the mortgage production called other concepts when it comes to the loan production. So in the other concepts you would learn about the predatory lending. So the predatory lending is one of the concept where as a borrower we must know. So predatory lending is an umbrella term that is generally used to describe cases in which a broker or originating lender takes unfair advantage of a borrower, often through the deception, fraud, or manipulation, to make a loan that contains terms that are disadvantageous to the borrower. So while there is no universally accepted definition, predatory lending is associated with the following some of the loan characteristics and lending practices. So the first one is excessive fees. Abusive loans may include fees that greatly exceed the amounts justified by the cost of the services provided and the credit and the interest rate risk involved. So lenders may add these fees to the loan amounts rather than requiring payment upfront, so the borrowers may not know the exact amount of the fees they are paying. Next thing is the excessive interest rates. Mortgage interest rates are legitimately vary based on the characteristics of the borrower, such as the creditworthiness and of the loan themselves. However, in some cases, lenders may charge interest rates that far exceed what would be justified by the risk-based pricing calculations, or lenders may steer a borrower with an excellent credit record to a higher rate loan instead for the borrowers with the poor credit histories. Next one is single premium credit insurance. Credit insurance is a loan product that repays the lender should the borrower die or become disabled. In the case of single premium credit insurance, the full premium is paid all at once by being added to the amount financed in the loan, rather than on a monthly basis. Because adding the full premium to the amount of the loan unnecessarily raises the amount of interest borrower pay, single premium credit insurance is generally considered inherently abusive. Lending without regard to ability to repay. Loans may be made without regard to a borrower's ability to repay the loan. In these cases, the loan is approved based on the value of the asset, the home, that is used as a collateral. In particularly some of the cases, monthly payments have equaled or exceeded the borrower's total maturity income. Such lending can quickly lead to foreclosure of the property. Next one is loan flipping. Mortgage originators may refinance borrowers' loans repeatedly in a short period of time without any economic gain for the borrower. With each successive refinancing, these originators charge high fees that strip borrowers' equity in their homes. Fraud or deception. So, predatory lenders may perpetrate outright fraud through the actions such as inflating the property appraisals and doctoring loan applications and settlement documents. Lender may also deceive borrowers by using a bait and switch tactics that mislead the borrowers about the terms of their loan. Unscrupulous lenders may fall into disclosed items as required by the law, or in other way may take advantage of the borrower's lack of financial sophistication. Prepayment penalties. Penalties for prepayment a loan are not necessarily abusive, but predatory lenders may use them to trap the borrowers in high cost loans. Balloon payments. Loans with the balloon payments are structured so that the monthly payments are lower, but one large payment, the balloon payment, is due when the loan matures. But in the case of predatory loans, it may contain a balloon payment that the borrower is unlikely to be able to afford, resulting in a foreclosure or refinancing with additional high cost and the fees. Sometimes lenders market a low monthly payment without adequate disclosure of the balloon payment. Predatory lending is difficult to define partly because certain loan attributes may or may not be abusive, depending on the overall context of the loan and the borrower. For example, although the prepayment penalties can be abusive in the context of some loans, in the context of other loans, they can benefit the borrowers by reducing the overall cost of the loans, by reducing the lender's prepayment risk. Originating lenders of brokers that engage in abusive practices can make high profits through the excessive points and fees that they charge, particularly when the borrowers make their payments regularly. Even when a loan enters foreclosure, the originator of a predatory loan may still make a profit due to the high up, the front fees it has already collected. Moreover, a lender that sells a loan in the secondary market shortly after origination no longer necessarily faces financial risk from the foreclosure. Similarly, a mortgage broker that collects the fees upfront is not affected by the foreclosure of the loan. So, the predatory lending also serves to harm the reputation of the honest and legitimate lenders, casting them in the same suspicious light as those making unfair loans and thus increasing their reluctance to extend credit to the traditionally undeserved communities that are often targeted by the abusive lenders. So, as you already know, we discussed about several documentations on why they are used. So you might be wondering how those documents might look like. So I thought let me add some of those sample documents to the deck so that you will get a ballpark idea on how those mortgage related documents would look like. These documents might be slightly outdated as the US federal government make changes to those documents based on the market conditions. So please feel free to open these documents and go through them. That will give some a basic idea about how these documentations, what all the content of those documentations when it comes to loan production. That's all for this lecture, and I hope you enjoyed this session. I will see you in the next new module called as mortgage servicing. Thank you.